Listen, I want you to picture something. A Friday afternoon in March of 2026, a corner booth in a restaurant in Nashville, Tennessee. His name is Paul. He is 61 years old. He owns a regional HVAC service company he founded in 1998, 16 service vans, 41 employees, annual revenue of approximately $4,200,000. Net cash flow to Paul personally, after all expenses and salaries, approximately $380,000 per year. Paul has been running the company for 28 years. He built it from himself and one assistant in a leased warehouse to a regional operation, with a fleet, a dispatch system, and a management team that mostly runs itself. He is tired. He is ready to sell. He has a buyer, a private equity-backed HVAC roll-up company that has made a letter of intent offer of $3,800,000 for 100% of the business assets. Paul also has a SEP IRA with $890,000 in it. He has been contributing the maximum to the SEP every year since 2003 as his primary retirement savings vehicle. He has a small taxable brokerage account at Edward Jones with $145,000. And he has the house. Paul is sitting in the corner booth with his business broker on a Friday afternoon because the broker just sent him a summary sheet showing the net proceeds from the business sale. The business sells for $3,800,000. After the broker's 10% commission of $380,000, the pre-tax proceeds are $3,420,000. The business is structured as a sole proprietorship for tax purposes. The gain is a mix of ordinary income on the recaptured depreciation and long-term capital gains on the remaining appreciation. The broker estimates the federal and Tennessee tax on the sale at approximately $580,000. Paul nets approximately $2,840,000 from the business. He is pleased. He calls his wife Janet that evening and tells her the number. He tells her they are set. They are going to retire this summer. He is going to roll the business proceeds into an investment account, draw from the SEP IRA, and live comfortably on the combined income for the rest of their lives. What Paul does not know, what the business broker does not know because business brokers are not tax advisors, what the Edward Jones broker does not know because he manages the taxable account and has never been asked about the SEP IRA and the business sale in the same conversation, is that Paul is walking into two separate retirement traps simultaneously. Not one, two. And the two traps do not operate independently. They interact. The interaction amplifies the cost of each trap individually and produces a combined tax outcome that is materially worse than the sum of the two traps modeled separately. Trap 1. The business sale income spike that captures the SEP IRA required minimum distribution in a 37% ordinary income environment. Trap 2. The SEP IRA that was never positioned for tax-efficient distribution, interacting with the business sale proceeds in the same tax year at rates Paul never planned for. The dual exit trap. Two separate wealth accumulation vehicles. Two separate exit events. One catastrophic income stacking consequence that the broker's summary sheet does not show and that the Edward Jones statement does not disclose. That is what we are spending the next 30 minutes dismantling. Smash the like button right now. The small business owner who also has a significant IRA is the retirement planning client most systematically underserved by the financial services industry. Because the business sale is handled by the broker and the attorney, the IRA is managed by the financial planner. And the tax interaction between the two events is handled by nobody until the CPA calls in April of the following year with a number that cannot be undone. Every like on this video breaks the suppression and puts this analysis in front of one more business owner who is in the final years before a sale and who still has time to sequence the two exit events correctly. Hit it, subscribe, flip the bell. The suits and legal want me to say this is not financial advice. Fine, this is not financial advice. This is a forensic examination of how a business sale income event interacts with IRA distributions in the same tax year, and what the sequencing and structuring options are. Consult a CPA specializing in business transitions and a fee-only fiduciary who models both exit events simultaneously. What I can do is show you the math. Let me start with the foundational architecture of both traps. Trap 1, the business sale tax event. A business sale generates taxable income in the year of closing. The character of that income, whether it is ordinary income or capital gain, depends on how the sale is structured and what assets are being sold. An asset sale of an HVAC service company with $3,800,000 in proceeds typically includes several components. Equipment and vehicles generate ordinary income through depreciation recapture under Internal Revenue Code Section 1245 to the extent of accumulated depreciation. The depreciation recapture on $600,000 of equipment with $380,000 of accumulated depreciation generates $380,000 of ordinary income in the sale year. Customer relationships, goodwill, and going concern value generate capital gain income taxed at the long-term rate. For Paul's sale, the breakdown is approximately $380,000 of ordinary income from equipment recapture and $3,040,000 of capital gain from goodwill and intangible value. The federal tax on the $380,000 of ordinary income at the 37% bracket where Paul lands in the sale year is approximately $140,600. The federal tax on $3,040,000 of capital gain at the 20% long-term rate, plus the 3.8% net investment income tax under Internal Revenue Code Section 1411, is approximately $724,536. Tennessee has no state income tax. Total federal tax on the business sale, approximately $865,136. Paul nets approximately $2,934,864 from the $3,800,000 sale. The business broker estimated $2,840,000. The difference reflects more precise tax calculation. Paul is satisfied. He planned for approximately this outcome. Trap 2. The SEP IRA distribution trap. Paul's SEP IRA has $890,000 in it. He is 61 years old. He is not yet subject to required minimum distributions, which begin at 73. He does not need to take distributions from the SEP immediately. He is planning to let it continue compounding and begin taking distributions in his mid to late 60s as a primary income source. What Paul has not modeled is what his marginal tax rate will be on every SEP IRA distribution he takes in the years after the business sale. In the year of the sale, Paul's ordinary income from the equipment recapture and from any salary he paid himself from the business through the year of sale is already pushing his total ordinary income above $500,000. The 37% federal bracket applies to taxable income above approximately $731,200 for married filing jointly in 2026. Paul's ordinary income in the sale year may not reach that threshold, but his adjusted gross income in the sale year, combining the business sale proceeds with the capital gains, is over $3,800,000. The capital gains do not face 37% ordinary income tax, but the capital gains income pushes his MAGI well above every IRMAA threshold and into the fifth IRMAA tier. And if Paul takes any SEP IRA distribution in the sale year for any reason, that distribution lands on top of $3,800,000 of other income at the 37% federal rate. Every dollar of SEP IRA distribution in the sale year costs 37 cents in federal tax, plus any applicable state tax. And here is the specific interaction that makes the dual exit trap more expensive than either trap alone. The business sale proceeds, once received, must be invested somewhere. Paul is going to invest approximately $2,900,000 in a diversified portfolio. That portfolio will generate dividend income, interest income, and eventually capital gains distributions every year going forward. That annual investment income from the business sale proceeds stacks against Paul's baseline retirement income from Social Security and eventually from the SEP IRA distributions. The stacking amplifies the ordinary income rate on every SEP IRA distribution through the provisional income cascade under Section 86 and through the IRMAA mechanism through the 2-year look-back. Paul built 2 wealth vehicles in parallel over 28 years, the business and the SEP IRA. Each one would have been manageable in isolation. The combination of the 2 exit events in the same tax year and the permanent income stacking that follows creates a compounding tax rate on the SEP IRA that Paul never modeled and that his advisors never modeled together. Now let me show you the 5 specific structural decisions that determine whether Paul pays the maximum tax on both exits or the optimal tax on the coordinated exit. Decision 1. The business sale year timing relative to SEP IRA distribution planning. The single most powerful lever Paul has is the timing of the business sale relative to when he begins drawing from the SEP IRA. The year of the business sale is the worst possible year to take any SEP IRA distribution because the sale income pushes his marginal rate to its maximum. The year before the sale and the years after the sale, when the business income is no longer in the picture, are the optimal windows for SEP IRA distributions, or Roth conversions from the SEP. If Paul can close the business sale in late 2026 or early 2027 and use 2025 as a final year of coordinated pre-sale SEP IRA conversion, the 2025 tax environment is dramatically more favorable than 2026 will be, with the sale income stacked. In 2025, Paul's income is his business owner compensation of approximately $380,000, minus contributions to the SEP and other deductions. His marginal federal rate is 32% to 35%, depending on deductions. A Roth conversion of $80,000 to $100,000 from the SEP IRA in 2025 converts at the 32% to 35% bracket, rather than the 37% bracket that will apply to SEP distributions in the sale year and potentially in years when the business sale investment portfolio is generating significant income alongside the SEP. The pre-sale Roth conversion uses the pre-sale income level as the marginal rate baseline. Every dollar converted before the sale is a dollar that avoids the post-sale income stacking that elevates the marginal rate on SEP distributions. Decision 2. The business sale structure. Asset sale versus stock sale. The $3,800,000 letter of intent is for an asset sale. The PE-backed buyer wants the assets, not the legal entity, which is standard for HVAC service companies where the legal entity may carry legacy liabilities. The asset sale forces the depreciation recapture as ordinary income. Paul cannot avoid that recapture in an asset sale structure, but Paul's attorney should be evaluating whether a partial stock sale or a hybrid structure could shift some of the gain from ordinary income to capital gain treatment. For a sole proprietorship, the stock sale option is limited because sole proprietorships do not have corporate stock. But if Paul had converted the business to an S corporation before the sale and held the S corporation stock for more than 5 years, the gain on the sale of qualified small business stock might qualify for the Section 1202 exclusion, potentially excluding up to 100% of the capital gain on the first $10 million of gain. The Section 1202 exclusion requires the business to be incorporated as a C corporation, not an S corporation, and requires the stock to be held for more than 5 years, among other requirements. Paul's sole proprietorship structure does not qualify. This is a planning failure that occurred years before the sale, when the business structure was never evaluated for Section 1202 eligibility. For business owners who are 5 or more years away from a sale and who are currently structured as sole proprietorships, S corporations, or LLCs, the conversion to a C corporation for the purpose of qualifying for Section 1202 at a future sale is worth evaluating immediately. The Section 1202 exclusion is the single largest available federal income tax benefit for small business owners who eventually sell their companies, and it requires structural planning years before the sale event. Decision 3. The installment sale structure to spread the business sale gain across multiple years. Rather than receiving all $3,800,000 at closing in a single tax year, Paul can negotiate with the PE buyer for an installment sale under Internal Revenue Code Section 453. Each year, Paul receives an installment payment. He recognizes a proportional share of the gain and the depreciation recapture. The depreciation recapture, approximately $380,000, must be recognized in the year of sale under Section 453I, regardless of the installment schedule. It front-loads. But the capital gain portion of the sale, approximately $3,040,000, can be spread across the installment period, recognizing a proportional share each year. If the installment period is 5 years, Paul recognizes approximately $608,000 of capital gain per year, rather than $3,040,000 in a single year. The $608,000 per year of capital gain, combined with Paul's other retirement income, likely remains within the 15% federal long-term capital gains bracket, rather than crossing into the 20% rate and the 3.8% NIIT that applies when MAGI exceeds $583,750 for married filing jointly in 2026. The installment sale generates a meaningful capital gains tax saving. The risk of the installment sale is the buyer default risk. If the PE buyer defaults on future installment payments, Paul has already transferred the business but may not receive the full consideration. The installment note should be secured against business assets or by a personal guarantee from the PE firm's principals to reduce the default risk. Tell me in the comments right now. Tell me whether you own a business and have an IRA. Tell me the approximate value of the business and the IRA balance. Tell me your business structure: sole proprietorship, S Corp, C Corp, or LLC. Tell me your state. Tell me whether you have a target sale timeline. Drop the numbers. I read every single one. We model the dual exit timing and structure together in the comment section. Decision 4. The qualified opportunity zone investment for the capital gains from the business sale. If Paul holds the QOZ investment for at least 10 years, any appreciation on the QOZ investment itself is permanently excluded from income. The QOZ investment defers the $3,040,000 capital gain until December 31st, 2026, under current law, or until the investment is sold. The QOZ investment defers the $3,040,000 capital gain until December 31st, 2026 under current law, or until the investment is sold. The tax on the deferred capital gain is owed when the deferral period ends. The benefit is the time value of the deferred tax payment and the permanent exclusion of appreciation. For Paul, deferring $3,040,000 of capital gain tax of approximately $724,536 for 10 years and investing that at a conservative 6% annual return generates approximately $1,297,000 at the end of 10 years. Even after paying the deferred capital gains tax at the end of the deferral period, the return on the deferred tax capital during the deferral period is meaningful. The QOZ strategy requires careful due diligence on the specific fund chosen, the quality of the underlying investments, the fund sponsor's track record, and the liquidity constraints. It is not appropriate for every seller. But for a business owner like Paul, who has sufficient other liquidity from the business sale net proceeds and from the SEP IRA to fund retirement without needing the deferred gain immediately, the QOZ deferral is worth modeling. Decision 5. The SEP IRA Roth conversion ladder in the post-sale years coordinated with the business sale proceeds investment income. After the business sale closes and Paul is living on the investment income from the $2,900,000 in reinvested proceeds, his annual taxable income depends on how the proceeds are allocated. If the proceeds are invested in high dividend equity funds and taxable bonds, generating 3% to 4% in annual income, Paul has approximately $87,000 to $116,000 per year in investment income from the sale proceeds. This income stacks against any SEP IRA conversions. The optimal post-sale Roth conversion strategy sizes each annual conversion to fill the available bracket space without crossing IRMAA thresholds. If the investment portfolio generates $90,000 per year in income, and Paul's Social Security at 70 adds $46,128 in taxable income, his combined baseline MAGI in the post-sale retirement years is approximately $136,000 before any SEP IRA distributions. He has $76,000 of headroom to the $212,000 IRMA threshold. He can convert $76,000 per year from the SEP IRA to Roth while staying below the first IRMA tier. Over 10 years of post-sale Roth conversions at $76,000 per year, he converts $760,000 from the SEP to Roth, paying tax at the 22% federal bracket and eliminating that balance from future RMDs. The RMD at 73 on the remaining SEP balance of approximately $400,000 after 10 years of conversions offset by growth is approximately $15,094 per year, rather than the $40,000 plus RMD that the full $890,000 growing balance would have generated. The post-sale Roth conversion ladder, coordinated with the investment income from the business sale proceeds, is the mechanism that prevents the dual exit trap. The business sale was the exit from the first wealth vehicle. The post-sale Roth conversion is the exit optimization from the second wealth vehicle. The coordination of the two is the dual exit solution. Let me now give you the geographic dimension. Tennessee has no state income tax. Paul's business sale generates only federal tax. His post-sale Roth conversions generate only federal tax. Tennessee is one of the most favorable states in the country for a business sale and IRA exit combination because the absence of state income tax reduces the combined tax cost materially. A Paul equivalent in California pays the 9.3% California capital gains rate on the business sale gain in addition to the federal rates. The California ordinary income rate on the depreciation recapture reaches 13.3%. The California combined tax on the business sale is approximately $1,200,000 rather than Tennessee's $865,000. The California difference of $335,000 in additional state tax represents the geographic premium for running an HVAC company in California, rather than Tennessee. The Roth conversion in California costs 9.3% state income tax. A California business owner considering relocation before the sale to reduce state income tax on the gain is making a rational calculation for large enough gains. The establishment of genuine domicile in a no-income tax state like Texas, Florida, Nevada, or Tennessee can eliminate the state income tax on the sale gain entirely if it precedes the closing date. In Texas, which is the most common relocation destination, establishing domicile requires registering vehicles in Texas, updating voter registration, using a Texas address for all financial accounts, and demonstrating the intent to make Texas the primary residence. The state income tax savings on a $3,800,000 business sale for a California resident relocating to Texas can exceed $400,000. The relocation must occur and domicile must be established before the sale closes. A sale that closes before the domicile change is complete results in the gain being taxed in California. In Florida, the same domicile change eliminates both the state income tax on the business sale and the state income tax on all future Roth conversions from the IRA. The dual exit trap in Florida, with no state income tax on either event, is the lowest cost version of the same transaction that Paul is executing in Tennessee. Now let me give you the 5-step action sequence. Step 1. If you are 5 or more years from a business sale, evaluate the Section 1202 Qualified Small Business Stock Exclusion. Determine whether converting your business structure to a C corporation now would allow the stock to qualify for Section 1202 at sale. If eligible, the gain exclusion of up to 100% on the first $10 million of gain per taxpayer is the highest available federal tax benefit on any business sale. Consult a business tax attorney immediately if you believe your business could qualify. Step 2. If you are 2 to 5 years from a sale, execute Roth conversions from the IRA at the current pre-sale income level. The pre-sale years are the last years when your marginal rate is determined by your business income. Convert as much as possible from the IRA to Roth before the sale at the pre-sale rate. Step 3. When structuring the business sale, evaluate the installment sale option alongside the lump sum close. Model the capital gains tax in both scenarios. If the installment sale keeps annual capital gain recognition below the 20% federal threshold, the installment structure is preferable. Confirm the buyer's creditworthiness and secure the obligation appropriately. Step 4. Evaluate the QOZ fund investment for the capital gain portion of the business sale proceeds. Get investment proposals from 2 to 3 QOZ fund sponsors. Model the combined tax deferral and 10-year appreciation exclusion against the investment risk and liquidity constraints. Determine whether the QOZ deferral is appropriate given your total liquidity. Step 5. After the sale, build the post-sale Roth conversion ladder coordinated with the investment income from the reinvested sale proceeds. Calculate the annual IRMAA safe conversion amount. Execute annual conversions at that rate for as many years as the headroom allows. The goal is to reduce the IRA balance enough that future RMDs do not push the combined MAGI above the IRMAA threshold. Save this video right now, hit the save icon, add it to the Retirement Survival playlist. Paul is in a corner booth in Nashville on a Friday afternoon with a $2,934,864 net number and a plan to invest it and draw from the SEP IRA and live comfortably for the rest of his life. The number is real. The plan is incomplete. The SEP IRA and the business sale proceeds are going to share a tax return for every year of Paul's retirement. The interaction between those two income sources in the provisional income formula, in the IRMAA calculation, and in the marginal rate applied to each SEP IRA distribution is the hidden cost structure. Subscribe if you have not. Flip the bell. Comment with your business structure, estimated business value, IRA balance, and state. Tell me your target sale timeline. We model the dual exit sequence together in the comments section. I read everything. The business was the first accumulation vehicle. The IRA was the second. Both were built with discipline and intent over decades. The exit from both requires the same discipline and intent applied to the tax structure, the timing, the conversion sequence, and the investment allocation after the sale. The dual exit trap was not built maliciously. It was built by the intersection of a capital gains tax on business appreciation, an ordinary income tax on IRA distributions, and a Medicare surcharge on MAGI. The intersection is not avoidable in total, but it is manageable with sequencing, structuring, and conversion planning that starts before the sale closes. Build the dual exit plan. Start it before the corner booth meeting. I will see you in the next one. Stay strategic. Stay furious. The dual exit trap was designed for the business owner who exited the business and left the IRA planning to tomorrow. Tomorrow is today. Start the IRA sequencing now.